Hello, everyone, and welcome into crushthestreet.com. I got a very special guest on the line with me today, Harry Dent. He's a best-selling author, renowned economist. His website is dentresearch.com. We're going to be discussing trade wars, stock market fears, triggers for the economy, gold, and possibly some more stuff here. Harry Dent, thanks for coming on Crush the Street with me today.
Yeah, sure. Good to be back, Kenneth.
Harry, we just received news that the U.S. trade deficit is now at a 9.5-year high. They released it this morning. This seems to be a very big deal to the Trump administration, something he campaigned on, and something that he's now addressing with the tariffs. And I got to ask you, what do you make of it?
Well, number one, my most recent book called 0 Hour, I put this out in a rush because Trump got elected against the polls, and Brexit happened against the polls, and something I've been warning about for a long time. To me, seems like it's finally happening, that there's a backlash against globalization, and there's kind of like a political revolution brewing, which would literally, on a 250-year cycle, be like the American Revolution and the invention of democracy itself, which is a very big deal. And that's what I see happening, that globalization has been surging since World War II for the second time with jet travel and internet and all these new technologies and communications. And it has succeeded so much that it is starting to fail. That workers in the best developed countries, from the United States to Europe to wherever, are saying, you know what, we don't see this in our advantage anymore. This globalization has brought in all these foreign competition in wages from Asia and immigrants from Mexico and illegal immigrants even worse. And we don't see this as a good thing anymore. So I see Trump's thing, he's simply representing his base, which I do not think are the smartest people in the world. I call them the all-star wrestling fans. But they're saying, hey, this is not good for us. And I understand that. Their wages have gone nowhere since 2000, in fact, even down adjusted for inflation. So first of all, this whole thing about, tariffs and trade and immigration and foreign competition is a big deal. And this is something that's going to take decades to work out. The last time we saw a backlash against globalization was World War I through the end of World War II, with the Great Depression in between. And the world did the same thing back then. Everybody started putting up tariffs to protect their own industries when the pie was shrinking and the world was looking less, global and feasible. And it just built on itself. It is a lose-lose situation. This is exactly what happens. We put up tariffs on China. China reacts and puts up tariffs on us. And all that happens in the end is that we have less global trade, and less global trade means less specialization and countries doing what they do best, and it's not good for the economy. So I think this is something that's baked in the cake, because it's coming from human emotions and reactions, which always happens. And no cycle goes up. We were one of the few people that predicted this global boom, and the U.S. boom especially, as well as the collapse of Japan in the 1990s. From demographics and other cycles. And now we're saying, this boom is over, and it's only quantitative easing holding this together, and that is starting to run out of steam as the U.S. pulled back and after late 2014, and now Europe's starting to pull back, and even Japan's talking about potentially pulling back. We've been living off of free money, something for nothing, since 2009, and now Donald Trump just added tax cuts at the top of the greatest profit boom in corporate history as a percentage of GDP. It's like the last thing companies need is a tax cut. But he did it to stimulate the economy because there's just no way to keep this bad demographic and debt trend going. Demographics and debt have been working against the economy since 2007, as we predicted 20 years before, and it's going to continue. We have more debt than ever. Demographics only get worse in developed countries in the next several years. So I say that this fake, if you want to call something fake, this fake rally since 2009 is getting ready to peak somewhere between January, maybe more likely, maybe around August of this year. And then we're going to see a crash that makes 2008 and 9 look like nothing.
Mr. Dent, I gotta ask you then. I'd like to unpack this concept of a trade deficit maybe a little more. And, I think about maybe my own personal life, my own personal business, and maybe it's the wrong comparison with my interactions with my vendors. And in theory, I have a negative trade deficit. I purchase more from them than they purchase from me, in many cases, nothing. And it's because of abundance and a successful business on my end that I'm able to go out and buy things from others. And I'm just wondering if a trade deficit is a relevant metric for how bad a situation is.
Well, trade deficit, like you say, it's got both sides of it. It is because the countries, some of the countries at least, that have big trade deficits like us are affluent, and we can afford to buy stuff from countries like China that are not nearly as affluent. Everybody thinks Chinese are rich. They are not. Go over there and go past Shanghai. The average wage over there is $2,000 to $3,000 a year back in the countryside. Overall, it may be $8,000 and rising, and adjusted for standard, cost of living, maybe $12,000, but they're not nearly as rich as us. So yes, we can afford to buy more from them than they do from us. So that's a positive thing. But if you run a trade deficit forever, which we've done since the early 70s, it's like borrowing money. It's like you're borrowing money from the people you're buying this stuff from. It's like these countries are extending us credit. They buy our treasury bonds to fill this trade deficit gap. And so if you do that forever, you are like running up debt. Now, that is not the biggest problem to me. Our trade deficit is not as big an issue to me as the fact that we have been borrowing at 2.7 times GDP growth since the early 70s. That's the biggest problem I see. So but you put them together, we are living on debt, whether you're borrowing from the people selling you more than you're buying from them, or you're borrowing from banks and with treasury bonds and everything else. We're living on debt, and you cannot borrow 2.7 times as much as you're earning for very long without running into trouble. And we've been doing this for decades. That's the biggest problem to me. But the trade deficit only adds to that because we are borrowing. I mean, Chinese own, I don't know, trillion plus of our treasury bonds, and that's a sign of our trade deficit with them. We're borrowing from them to buy more than we sell to them.
Yeah, that was put very well. Okay, so tensions with China seem to be escalating in the sense that China started with a first $3 billion retaliatory response and has now upped it to $50 billion. And so what do you make of this game of chicken in this geopolitical chess game?
But I mean, this is what happens. History is crystal clear on this. Trade wars don't work. They're natural. When the pie starts to look fixed instead of ever growing, or when some people start losing in the game of globalization or trade or whatever, then this is what happens. Certain countries start to raise tariffs to protect their industries, and then of course other countries retaliate. What else are they going to do? Of course China's going to say, hey, we're going to retaliate and put tariffs on you. So it's a lose-lose game. I don't know any economist that's looked at history that says trade wars are a win-win game. It's a lose-lose game. On the other hand, it's just human nature, and it will happen. We predicted this would happen in our latest book. It is happening right before our eyes, and it's only going to get worse. And this could last a decade or more.
Okay, so one more question on this. So most Austrian economists agree tariffs are bad. It crushes comparative advantage. It's a misallocation of capital. The money gets redirected to the government in the form of taxes, so it feeds the beast. But if this is true, in the long-term perspective, should we care that China and the EU and everyone else imposing tariffs on U.S. goods are doing it if they're just shooting themselves in the foot? And do these policies actually hurt U.S. companies in the long term, or is it short-term thinking on our part?
Well, obviously, it's going to hurt some industries in the U.S. and help others. I mean, and it's going to help some countries a little more and hurt some other countries a little more. Part of what we see, Kenneth, and we've been saying this for years and years and years, this whole period since 2008 is what we call the winter season. It's a big shakeout. It's a deflation in asset prices, a deleveraging of debt, and all of that basically forces businesses to compete harder to see who's going to win. It shakes out. We've had so many businesses and so many industries, and I even look at Bitcoin as a short-term example, like hundreds of companies come out of nowhere with no profits, just like the internet bubble in 1999, and they're able to just put coins on the internet and raise money, even though they got nothing. And I mean, 9 out of 10 of these companies have nothing but invisible coins. They don't even have real blockchain technologies except to create their coins. And so you let all this innovation happen in a boom like this from 1983 to 2007, and then you get to this period where everything slows down, and you know, all of this stuff is challenged. Tariffs, slowing economy, high debt, you know, recessions. I think we're on the verge of a recession that makes 2008 and 9 look like nothing in the next few years. And it's going to shake down in the largest industries, mature, and in the emerging industries like tech and Bitcoin and biotech, down to the companies that really have the stuff. If you survive this shakeout, when everything's going down, you're going to gain market share at the expense of your competitors that are failing. And there's going to be a lot of failing companies. I think 9 out of 10 Bitcoin cryptocurrency companies are going to fail in the next few years. And then many companies in every industry. And that's a good thing. That's what happened in the early 1930s. We shook out everything, especially the emerging auto and electrical industries and things, and then had nothing but boom after that, with the surviving companies being bigger, stronger, meaner, more efficient, lower cost than ever, which ends up benefiting consumers. So this is a natural process. And my problem, Kenneth, is that governments, which I hate central banks. I would be happy if we had no central banks. We don't need these assholes except to create liquidity in crises. They don't need to set interest rates. Markets are very good at that. They pervert the system by stimulating. They're preventing this very crisis we need to shake out unprecedented debt and leverage, unprecedented financial asset bubbles, which are bad for the economy. High real estate prices, especially in the biggest cities around the world, are bad for business, bad for the economy, because people can't afford to live in San Francisco or New York or Sydney, Australia, or Singapore anymore, or Shanghai. And this is bad. We need to shake this stuff out and then reset our economy like we did in the 30s, and then go forward with much lower cost, better competition. And we got a lot of companies that don't need to exist, and a lot of debt that is no longer productive and just needs to be wiped out and deleveraged. And of course, that's painful. That's why central banks are saying we won't let this happen. No central banker or president or premier of a country wants to have a Great Depression or deleveraging on their watch. So they're using every tool possible. But this is cheating. And yes, the Chinese are cheating. I mean, I agree with Trump on one thing. The Chinese do have unfair trade advantages over us. They have taken advantage of us. And we should really focus our trade policies on China and not put across the board tariffs on things like steel and aluminum. We should say, oh, no, it's these countries like China that are competing unfairly and that are dumping, and we will set things with them that makes that on a fair trade basis and go forward, but not, I mean, everybody putting up tariffs is not going to be a good thing.
Right. Yeah, no, well put. So let's talk about stocks. The tech stock pullback, the trade war escalation has seemed to rattle the market. Overall stocks are down since the start of the year. Yesterday, by the way, today is April 5th. On April 4th, we had the Dow Jones down 500 points and then ending the day up 230 points for the day. Just kind of a crazy thing. And it's almost like we all are expecting this big correction in stocks, and we don't exactly know what the pin is going to be that bursts the bubble, right? I mean, and it could be trade wars, it could be, unemployment, it could be who knows what it might be, but it seems like it's starting to come unraveled here.
Yeah, when the whole Bitcoin thing became headline news, I was one of the first to say, look, this is not the bubble because it's so small. The whole cryptocurrency thing, you've added them all up, was like 800 billion in market cap, a third of what the internet bubble was initially in 1999 when it came out and bubbled up 8 times in a year and then burst 93%, which I think is the same thing happening right now with cryptocurrency. It's not the bubble because it's not big enough to take down the economy, but it is a pin. And these trade wars, which you're bringing up here, this has been the first. I mean, this stock bubble has ignored every bad news in history and shrugged it off. But this is the first time since 2009 that this market has sat back and said, "Oh, wait a minute, whoa, this is something to consider." And so we have had this correction. Now, I was originally saying, hey, this could have been a top in late January because it was a very parabolic rise. It was going up in a classic channel, did an overthrow, which is a classic sign of a top as well. And then we had a sharp crash. But my research also says, by looking at every major stock bubble in the last century, that once a stock bubble of this magnitude or near this magnitude does burst, you're going to typically see 40% down in the first 2.5 to 3 months. Well, we're 2 months into this correction, at least if you measure by the Dow, and only maybe 1 month if you measure by the NASDAQ top later. But we're well into this, and we haven't seen as sharp a correction as I would expect. So I am increasingly thinking that this is a correction on the way up in this final bubble, and that we'll probably see one more rise in stocks, probably into as late as August. And the reason I say August, Kenneth, is that late August would be the time period that would equate this bubble and boom with the longest boom and bubble in history, which was from October 1990 through March 2000, the whole tech bubble that peaked there with the internet bubble at the very end, just like Bitcoin. I mean, all the things are happening the same. So I think it's probably more likely we're going to see one more rally, maybe because Trump does a second tax cut, or there's some negotiations with China or something. But the fundamentals are still the same. Trade wars or not, Trump or not, tax cuts or not. The truth is tax cuts are not going to create 4% growth. If they do, I will shoot myself in public. It's just not possible with workforce growth is zero for the United States. We're just continuing to hire back people we lost in the downturn. Productivity's down to 0.5%. It used to be 3% in the good old days, and by my projections, it's going to go to zero or negative because we're going to continue to see baby boomers age and retire. Old people are not more productive, and then they die after they retire on top of that. And dying people kill real estate, as they've already done in Japan. Japan's real estate went down 60% in the 1990s and has never rebounded, even with their millennial generation, because now there's more old people dying than there are young people coming along buying. And Japan has 10 million vacant houses, rising towards 20 million in the next 15 years. Real estate gets devastated when a large generation like the baby boom dies and outweighs the next generation. And this has never happened in modern history. So again, what we do, Kenneth, we look at demographic trends. Don't ask me why economists don't. They're just idiots, is all I can say. They look at all these statistics and detailed facts and stuff, and they totally miss the forest for the trees. Demographics are destiny. And demographics caused the collapse of Japan in the 1990s, which we alone called. They caused the slowing in US and Europe on a lag since 2007, which we called decades in advance. And we've been living on quantitative easing ever since. And they're going to continue to get worse in most developed countries. And the stock market's going to have to get in tune with the fact that no amount of stimulus, no amount of tax cuts will get companies to reinvest when they have declining or slowing demand from consumers. All they're doing is buying back their own stocks with this free money, increasing their earnings per share, but not increasing the economy past a paltry 2% growth since 2009. And we wouldn't even have that without $14 trillion poured into the bathtub that is leaking everywhere else. I mean, governments are just making up for the demographic decline and the debt pressures that are both unprecedented. And you can't do this forever. You can't grow an economy forever on nothing.
Yes, no, understood. So Harry, you made some calls about the stock market, and I'm wondering are we still looking at a percentage decline in the stock market, or is it still more of a hardline figure? Because you said, we really can't fight the demographics, and it was a powerful statement there. But I'm wondering if, this Dow Jones is at, 24,500 or so, a 50% decline makes that 12,000 point Dow. And, at 15,000 point Dow, a 50% decline would be, 7,500. And I'm just wondering, does the higher stocks go, does it create a higher floor for how low you expect them to go?
Yeah, I mean, because it has to go to the same place in the end. Our target in the next few years is about a 5,500 Dow. So if it goes up to 28,000 instead of 26 recently, then it's just going to have to fall more to get there. But to me, Kenneth, the sign I'm looking for, since I've learned that governments are so determined to keep this bubble going and just keep throwing more and more of the kitchen sink at it. I mean, again, these tax cuts from Trump, the last thing we need is tax cuts when businesses, even with free money in the last 9 years, are not investing in new capacity. They're just buying back their own stocks. In fact, they're the only net buying in the whole stock market. So the sign I'm looking for is if we see a 30% or more crash, then that'll say to me this bubble's over. A 20% correction you can have and still be in the bubble, but 30 to 40% says it's over. We've only seen 12% recently. That's not enough. This is still a correction to me until we see a steeper crash and we see probably at least 30%. So that's going to say, we got to see 6,000 or 7,000 Dow points. And then if we do that, 40% is the more likely target. And again, that could bring us down to as low as 16,000 in a matter of months if we get this break and sharp crash. But we're not getting it here. I'm starting to say to my subscribers, this is looking more like a correction, and we probably got one more wave up in this bubble. And I also say, bubbles have stages. They get more and more exponential, but the last stage is what I call the orgasmic blow-off. And that started when Trump got elected because the stock markets were down 1,100 overnight and then up 900 the next day, a 2,000-point reversal on high volume. And the stock market was saying, we smell tax cuts and pro-business policies. And that's exactly what they got. And so we're in, that to me is the final orgasmic bubble. The question is, when does this end? I say it's possible it ended in late January, but I'm thinking it's more probable it'll be late this summer in August. Late August is my best target, and something like 28,000 on the Dow. And then if we get to there, I would say take your money and run.
Yeah, Harry, you mentioned this twice now in the interview, and that is that companies didn't need a tax decrease. And I'm just wondering, from a morality perspective and from just a long-term positive for U.S. companies, isn't it a good thing that they got a tax benefit? And isn't it good for businesses here in the U.S. to attract businesses and to be more competitive globally? I know we had one of the highest corporate tax rates up until the corporate tax cut, from 35% down to 21%. Isn't that a good thing for businesses?
Here's what would be better. Just send everybody a $10,000 check. Wouldn't that be good for the economy? And if 10,000 is good, why not send people 20,000? You can't create something out of nothing. If anything I've learned in life is you don't get something for nothing. Businesses have had the best run in all of history. This makes the Roaring '20s look like nothing. To give businesses more money and profits when the top 1% and 0.1% who own businesses already control almost all the wealth in the country and in the world, is not good for the economy. You've got the generals going forward without the troops. The everyday workers going nowhere, and business people are making money hand over fist with zero interest rates, and now tax cuts when they're making profits that they don't even know how to reinvest. They can't reinvest their profits. They're making so much. This is not good for the economy. Of course it's good for business people. But again, if you think, well, you're going to create growth by just pouring money in the economy, or giving away stuff for free, or making money free, well, then just send everybody $20,000 in the mail. And
well, I mean, I'm just, I guess why is the default for the businesses to pay more in taxes? Why does it start at that point and then have to be an argument for why businesses should be able to keep more of their money? And I don't mean businesses specifically, but anybody. I don't believe that.
Why not make the tax rate zero if that's good for the economy? Well, here's the problem. We're running and projected next year in a boom, and I don't think there's going to be a boom by next year, but if the economy keeps growing at 2 or 3% or whatever, we're going to have a $1.2 trillion federal deficit in a boom. You're supposed to run surpluses in a boom and then deficits in the downturn. So what happens if we get another downturn like 2008 or 9, and I think it'll be worse than that when it happens after all this stimulus and debt is higher than ever? You're going to be running $2.5 trillion deficits a year. There's going to come to a point where the U.S. government can't sell treasury bonds because people say, you're looking like Italy.
No, I agree with you. I tend to think we have overwhelming amounts of data going against the U.S. government, and they're in a spot that I don't think they can back out of. But, and I can just tell you this from a fundamental perspective. When countries don't compete, businesses leave. And I can just tell you from a personal experience, I left California because of a very high tax rate. So instead of getting something from me, they get nothing. So, and from that perspective alone, I think it's important for the U.S. to compete and to attract business.
This is the greatest BS ever, that U.S. businesses are at a huge tax disadvantage. I'm in the U.S. for a reason. I would love to go to Canada. I would love to go to Australia. I would pay higher personal and business taxes if I did. You'd say, 35% is high, but we have deductions. Businesses don't pay 35%. They pay more like 20-some%. So it's BS that U.S. businesses are way overtaxed. Yeah, there's some things like things that repatriation, things like that may make some sense. But everyday businesses do not need a tax cut, and the U.S. government can't keep giving away money to people. We have the lowest marginal tax rates in decades and decades for personal, and we have low business taxes, really, or at least fair to me compared to the world. You can't keep giving away and not taxing your people and expect your government can survive when we're already in debt. I mean, our debt has been doubling every 2 administrations. $5 trillion before Bush walked in, $10 trillion before Obama walked in. Now Trump walks into $20 trillion. It could be $40 trillion 8 years from now. The way we're going, this is not sustainable. You just can't do it. And again, my most important statistic outside of demographics is U.S. debt, private and government included, and private is much bigger, has been growing 2.7 times GDP since the early 1980s. This is not sustainable. You can't keep living off of debt and something for nothing. And this is the biggest something for nothing economy ever. And it's more so since 2009. At least there were strong fundamental trends into 2007 to support this boom. Now we don't have fundamental trends, and we're living off of debt and free lunches and now tax cuts.
Right. Well, I think I guess what we're discussing here is you're talking about the income side and also the spending side. But I tend to think it's more of a spending issue that you're describing, the debt and the reckless government, and the income side being the taxes. I think it's a positive thing to incentivize, to attract businesses here, and then obviously deal with the debt issue of something for nothing. I don't think it's a...
That's why I disagree with you. We don't need any more capacity. We don't need to build another house for all of eternity. because the baby boomers had peaked in their housing demand, and the next generation will come along and at their peak will never need more housing than we need now. And in most countries, Japan and China, there's vacancies because of declining demographics. We don't need more capacity and investment. We need to get more efficient and deleverage debt so we can survive in the future when the demographic trends will never be as strong, ever, in the developed world as they were from 1983 to 2007. We don't need more business investment. It's the wrong thing to do. We need to deleverage debt. We've got massive amounts of debt, that 230 trillion in the world that is unproductive, invested in the past, and stuff that we no longer need for growth now. We need to deleverage that debt, and that will make us much more efficient and raise our standard of living in the future, but it's not going to come from demographics.
All right. Well, powerful words there by Harry Dent. Harry, I want to give you an opportunity here to share some information on what you guys have to offer, and info, content. If people want to learn more about what you're doing, where would they go and what would they find? And of course, thank you for coming on Crush the Street.
Well, the simplest thing, it just came out late November last year with a new book, 0 Hour. You got to read that book. And you can go to harrydent.com. Last I looked, they were offering that book for free with just shipping costs, and to get to know us. And at the upper right-hand side of that website, harrydent.com, you can just put in your email address and get on our free daily newsletter. We have a free daily newsletter that's really good, and we do this so people can get to know us. We have other newsletters and investment services and stuff, but we say, look, get to know us first. We're saying something radically different, as anybody can see from this interview. And you need to understand why we think differently. We don't have anything in common with most economists. I didn't even take economics in college. I started to, but I thought it was baloney. I developed all these new theories by studying real businesses and real consumers as a real life Fortune 100 and new venture business consultant. That's how I developed my theories on how the economy works, and that's how I stumbled on demographics and other things that give you a whole different perspective on the economy. And the best part of it, Kenneth, is simple. We tell you things you already know. We describe the economy saying it's people like you in your life cycle where you grow up and you're a pain in the ass teenager, and then you go to work, and then you get married, and then you have kids, and then you buy houses, and you're the people who drive our economy. And we look at people instead of government policies, which are fickle and are only 20% of the economy. Consumers and businesses are 80%. That's what we look at. So harrydent.com, get our book, get on our free newsletter, and then if you like us after that, hey, you can pay us something.
Harry, thank you so much for coming on Crush the Street. I really appreciate your time.
Okay. Enjoyed it, Kenneth.